how money works. The Great Corporate Extinction. 13-minute video. The Great Corporate Extinction. Apparently, I'm featured in this video.
2023 saw a record number of new businesses being created here in America, with 5.5 million new companies being registered within a year. Data hasn't been published for 2024 yet, but most expectations suggest this record could be broken again. At the same time, it seems like every
Okay, I hope he's gonna cover this, and maybe he will, but just to be so clear, this is DoorDash, Airbnb, and Uber. If you start a solopreneur Uber driving business, you create a small business so you can write all your expenses off on your taxes. But it doesn't mean that you're building a new business. This spike post-COVID is not like a sudden wave of entrepreneurship. This is people doing more gig work. This is like OnlyFans. Is that legal? Yeah, it's totally fine.
At the same time, it seems like every pre-revenue, pre-idea, pre-clue startup that vaguely mentions artificial intelligence is getting billions of dollars thrown at them by cashed-up investors. And yet, there is a problem that you may not have noticed. There just aren't that many companies anymore. In 1996, the market hit an all-time record of 8,090 companies publicly listed on the various stock markets around America.
Fuck, the 90s were great! Millennials, we can say it! We can proudly say it! The 90s were fire, dude! Thriving middle class? Budget surplus for America? Tech felt like it was gonna better our lives and not steal all of our attention and leave us sad and lonely?
Today, almost 30 years later, despite the economy being 3 times larger and the market handling about 7 times as much capital, there are fewer than half as many companies publicly available to buy shares in. There are a lot of theories about what is going on here, from private equity making Wall Street irrelevant, corporate consolidation, to the dwindling of savings of average investors. But there are some even bigger issues at play here. So, where the f did all the companies go?
Where'd they go?
The largest toy store chain in the U.S., Toys R Us, has filed for bankruptcy protection.
Well, that's private equity.
Purdue Pharma, the company that made billions selling the prescription painkiller.
Time is almost up for Bed Bath & Beyond, filing for bankruptcy protection and liquidating hundreds of stores.
Some tech companies go public a bit too.
I'm sorry, buy the dip. I didn't want to move on without telling you that if you don't take this opportunity now to buy the dip on Bed Bath & Beyond, you are missing your chance at generational wealth. BBB is due for a fucking comeback. I have been hodling. I took all my NVIDIA stock, sold that weak shit. I put it into BBB, and I've been hodling. Here's the thing, is so far we've seen the beds, and we've seen the baths, but what they're waiting for in 25 and 26 is to really show you the beyond. And that's when the fucking stock is gonna moon, dude. You can't buy it on the exchange anymore, so like, just send me money. Send me money and I'll give you some of my shares. I have so many.
And liquidating hundreds of stores.
Some tech companies go public a bit too early. We still see tons of opportunity to change and grow the business quite a lot.
These 7 companies have risen and risen until they've become basically all of the stock market.
At the time this video was released, 34.1% of market capitalization of the S&P 500 was
Dude, I'm so happy that my lawyers have something to do. I'm so happy that I get to sue how money works and show them how the legal system works, okay? When you steal my voice uncredited without permission. That's cash in my pocket. I'm taking the channel. No, that's cool. I appreciate the shout out somewhere in here. I don't know where it is, but he responded. Nice to hear the Glarketer making a cameo. And then How Money Works responded and said, quote, glizzy, glizzy, glizzy. I worked at NVIDIA. I am friends with Ludwig. No end quote. Big A. I didn't recall myself saying those words specifically. But clearly they're in the weeds. Clearly they aren't just a casual viewer here. They know the deep lore. Crossover episode? I'll get this disembodied head of a $, and we'll talk about bond yields or something.
Comprised of just 7 companies: Microsoft, NVIDIA, Apple, Amazon, Meta, Alphabet, and Tesla. If you throw in Berkshire, Broadcom, and Walmart, then that is over half of the entire market in just 10 companies. According to data from Standard & Poor's, at the end of 2015, the top 10 companies only accounted for 16.2% of the market. So in less than a decade, the market concentration within the biggest companies has tripled. Even if there were more companies that the public could invest in, they would matter a whole lot less. This trend is bad for investors, bad for workers, bad for consumers, and strangely, it's actually even bad for the companies themselves.
Just straight up, been saying. I don't know how long I've been saying, dude. I've been saying like as much as you can possibly been saying. This is what I've been super saying.
But I am getting ahead of myself. First, we need to know why this is happening. One of the big changes that most analysts are pointing to is the growing role of private equity. We have discussed the details of exactly what private equity is in a few videos, but if you are new here, all you need to know is that it's a firm that invests in companies or other assets that are not listed on public exchanges like the NASDAQ or New York Stock Exchange. According to the investment data firm Preqin, the amount of money that private equity firms are now managing in America alone is up 1,200% since the year 2000. So as this has grown, market share has been taken away from public exchanges. For a lot of companies, it's just not worth it to meet the compliance requirements of public listings because then
private equity is get a bunch of rich people money, buy a company that's generating cash flow, load that company up with debt, pay that money back to yourself, siphon it off, leave the shell of a company to die. At best, private equity, some of them have like a formula. There's a lot of local dentists in America that make money. They're doing pretty well. What if we buy dozens of these dentists? We buy 40 dentists at once, 40 private dentist businesses, and we roll them all up, and we have them on the same HR system, the same payroll system, the same scheduling system. We use one for all of them, so it's a cost saving. Well, there we've managed to save money. But that's why when you go to a local dentist, instead of getting like a receptionist that is like happy to be there, it's like a fucking tablet that is linked up to a system that has 50 other dentists. And the worst example is them like just running it into the ground and siphoning it for cash.
Early investors and management have to listen to thousands of stockholders instead of just one or two big private equity firms. Average investors also don't have that much money, and the average person owns most of their shares through managed retirement accounts anyway. Those retirement funds also invest in private equity firms, so going public doesn't really offer anything that can't be achieved by just selling to a private equity firm unless the company is absolutely massive. Even when private equity firms want to take profit on their investments, there is a growing trend of them just selling their assets to other, even bigger private equity firms. According to records from Apollo, one of the biggest private equity firms in the world, the number of companies financed by private equity increased by over 9,000 since the turn of the millennium. If these companies had to raise money the old-fashioned way through an IPO, then the number of public companies would be much more in line with the historical trend. So mystery solved, right? Wrong. There is one more story than just private equity ruining everything. Again, just having the same number of companies as the worst.
I want to drill that because this is what I've been saying, and I want to specific, is that, listen, the whole point of private equity is that you buy a business and somehow you, because you're the smart elite private equity guy, can make the business worth more. You can do something to it with your superior management knowledge to make it better. But in reality, they can't often do that. And so many times, many of these private equity companies are sitting around unable to be sold because they've made them dog shit. So they can't actually flip the company. Like for a while they could because money was so free. But in this higher interest rate environment we're in right now, there's a crisis brewing in private equity and private credit and all of these areas where, there's no buyers. You've taken this company that was shitty. You've made it worse. You can't flip it. And this problem is brewing. I don't know when it explodes. I don't know. But I just know that this is happening. When this is unfolding. Like private equity is facing a reckoning. And so what they're doing, like all industries in America, is when you see a structural problem that's going to fail, try to get as big as possible so you can qualify for a bailout. Like if you're doing something risky and stupid and you know it's going to fail, the solution isn't to cut back on your risk. That just means you're going to be saddled with your bad choices in the past. You go bigger. You double the risk. You triple the risk. You try to get as many people involved. You try to get pensions invested in your risk. You need to make it systemic so that the taxpayer can be on the hook. That is the real flaw in private equity.
Private equity increased by over 9,000 since the turn of the millennium. If these companies had to raise money the old-fashioned way through an IPO, then the number of public companies would be much more in line with the historical trend. So mystery solved, right? Wrong. There is one more story than just private equity ruining everything. Again, Just having the same number of companies as there were 30 years ago wouldn't account for the fact that the economy is much larger overall. If the relationship between businesses and business activity held, there should be something like 25,000 public companies, but there are actually less than 4,000. Not only are companies getting more concentrated, but their ownership is getting more concentrated as well. The largest shareholders in almost every major company listed in America and most of the rest of the world today is some combination of BlackRock, State Street, and Vanguard. Now, you have probably seen the endless thumbnails about these companies being evil empires plotting world domination. And honestly, that's probably not true. The reality is that they manage assets on behalf of millions of individual investors. They don't actually own that themselves. The index investment products they offer are also really convenient for most investors.
I mean, I agree with this 100%. I think there's many, listen, I don't think BlackRock's a good thing to exist, but people overstate how powerful it is so much. It's so overstated. Like, BlackRock is just everyone's 401k. Vanguard's everyone's 401k. It's just retirement funds. That's why they own a lot. It's people. It's the people of America that own a lot through these funds. But that in itself is problematic. But I've already had I think I've done 15 clips on this back in the day, so I don't want to go into it again. The dangers and the risks inherent in so much of the market being passive investing. I can't do the clip again, but go back and watch if you're interested. It's fascinating.
Investors who want diversified exposure to the market, but are unable to buy and balance hundreds of shares individually because that would take an inordinate amount of time and money. But even though this reality is a little bit less exciting than an evil empire operating from the shadows, it doesn't mean that its growing popularity is any less damaging to your actual financial situation. And to see why, we are going to have to roleplay as Wendover Productions for a second. According to public 13G filings, the top shareholder of Delta, Southwest, United, and American Airlines is the Vanguard Group, which owns millions of shares in each company, primarily on behalf of their clients through its index products. Collectively, American, Delta, Southwest, and United control more than 70% of the market for air travel within America, according to the commercial aviation data firm AOG. Individually, the best way for these companies to grow their business would be to take market share from one of the other three by offering lower prices, better service, or more convenient routes.
Yeah.
This is the basis of good, healthy competition. And in the battle days, when shareholders would largely own one company they believed in, this is how it would work. But when their largest shareholders also own an equal stake in every other business in the market, they are a little bit less keen on crushing their opposition. If Delta pushed hard against United on all of their routes, then they might take market share from them. But for their shareholders, all they have done is cut into their profit margins to win a war against themselves. Instead, the growing pool of shareholders that owns...
Yeah, this is the Matt Levine. He talked about this like 10 years ago. I feel like How Money Works read the same money stuff as me. This is the Matt Levine, but yeah, it's true that like collective ownership of every competitor, which is what we do through our 401ks and passive investing, makes companies less competitive, because if I own 50 shares of Delta and 50 shares of United, then if Delta does well at United's expense, I'm netting even. In fact, I might even be losing money. So, you know, I kind of want them to all just fucking collude, if anything. The Maroon 5 singer? No, that's Adam Levine. Matt Levine's a financial writer.
Stakes in all of these companies equally are going to be financially better off if these companies grow their margins by extracting more from their customers through cost-cutting service, more fees, and confusing bookings. If you can believe that that would ever happen. Now, even this by itself...
Doesn't it require a small active investor pool to balance the system? No, it requires a large active investor pool. Passive investing worked super well when it was small share of total trades. You're just piggybacking on everyone else doing the work. But now that passive investing is like over half of the market, then the smartest active investors just copy the passive. Okay? If the passive robot is buying Tesla, Amazon, Apple, Google, Nvidia every week with everyone's 401ks, then those stocks will outperform. And so the active investor just copies, because if not, they'll fall behind. And so you end up with a thing where the entire incentive for everyone, passive and active, is to pile into the same companies until it's disastrous. That's the risk. I mean, it starts to break down when it's that big a slice of the pie. It worked very well when it was small.
Itself isn't the whole story, because, spoiler alert, this little game isn't even good for the shareholders either. So it's time to learn how money works to find out why companies are going extinct. This video is sponsored.
There's one algorithm somewhere controlling all the strings. It's not an algorithm. It's you give me money, I buy. I buy the biggest things. Almost all of the investing in America is done through passive vehicles like 401ks, which just take part of your paycheck and buy the top stocks. That's it. I mean, that's all they just buy them. If you're more big, I spend more money on you. That's it. And so it knows what's the box to buy through an algo. I mean, calling it an algo it is an algorithm, but it's so disingenuous language because it implies more complexity than there is. There's nothing complex about it. And that just goes on and on. And so now everyone's piling in.
Sponsored by Vessi, aka the sneakers that have quietly taken over my daily routine. You know those everyday moments that don't make the highlight reel? Coffee walks, daycare drop-offs,
I'm included in the video, so I'll watch
is
the
made
ad.
for all of it. Their weekend sneaker is the one I keep by the door. It's waterproof,
Wow.
lightweight, and honestly just easy. Slip them on and you're out the door in seconds. I've worn them in the rain, over wet sidewalks, and even through a few too close puddles. And, well, they're still dry and still comfy. Plus, they look good. Clean, minimal design that works whether I'm in joggers or jeans.
Hell yeah.
They're comfortable enough to wear all day and durable enough to handle whatever the day throws at you. I've stopped checking the weather because it just doesn't matter
Doesn't
anymore.
matter.
Make every day
As long as you got your Vessis.
Visit Vessi.com/money now for 15% off your first pair at checkout and start exploring with confidence.
Try Vessi.com/Atrioc.
I'll take
It
a
doesn't
look.
exist,
But if they are all well regulated and they are not in vital industries, sometimes monopolies can be good for consumers, at least for a little while. Netflix once had a near monopoly on content streaming, and for a few years, it was really good. The price was reasonable, and in return, you could get access to an extensive library of on-demand content without the challenges and risks that came with sailing the high seas. But seeing the opportunity, companies like Disney, Apple, Paramount, NBC Universal, Amazon, and Warner Brothers all introduced their own offerings to the market and started locking their own content with their own subscriptions. Today, to get access to a comprehensive library of content, you would need about 5 or 6 different subscriptions, easily costing more than the cable this was all supposed to replace. Even the studios arguably did better under the Netflix arrangement, because they could license their content for additional revenue instead of losing billions of dollars every year trying to take market share. Now, this is actually nothing new. As new technologies emerge, lots of businesses try to get into the market and naturally only a few survive.
Sure.
Even the very first international corporations, the Dutch, British, and French East India companies, were effectively just state-sanctioned monopolies because that was the only way they would work. The difference now is that instead of raising money and starting a new business from scratch to take advantage of a new marketable technology, existing businesses just use their own cash to do it in-house. Netflix is the only major player in the streaming market that wasn't already a film studio or major technology company before getting into streaming.
Yep, true.
And outside of digital media, the lesson is the same.
To be clear, though, they're all winning. I mean, it's worth noting that like all these tech companies and studios that tried to do something that wasn't their core competency, they've done poorly. And Netflix is winning and profitable. So there's something to that. There's something to like not overstretching. Well, YouTube is ahead? Yeah, but I wouldn't say that is the streaming war here. It's all fight for attention, and then you could say Fortnite's ahead too.
Beautiful. A company like Amazon can offer same-day delivery and global cloud computing services because of its scale. Individual brick-and-mortar retailers could be content with operating out of a few select locations, but to compete directly with Amazon would require an investment of hundreds of billions of dollars into an immense network of warehouses and distribution centers. It's easier for most businesses to just give up and sell through Amazon instead. Legacy brands like Toys R Us or Bed Bath & Beyond just can't compete on price or convenience with their smaller scale and higher overhead. Social media, like the brands under Meta, only have value if everybody is using the same service, so users naturally gravitate towards the largest providers in any particular niche.
Russian
If you want to shout about
Facebook?
how hard it was back in your day under Minion memes, you go to Facebook. If you want to shout about how hard it is under the current day under Bernie memes, you go to Reddit. And if you want to shout about how hard it is to synergistically integrate the joint development interregional self-layoff project, you go to LinkedIn.
Okay.
Because that's where you will find fellow boomers, fellow comrades, and fellow corpo bots respectively. Now, I know you know that antitrust regulation is severely lacking here in America, and most of the rest of the world.
True.
But even if we are actually good at playing Monopoly Whack-A-Mole, they will naturally keep popping up. Companies themselves are less resistant to being acquired because a lot of their investors are the same people on both sides. And a single entity that isn't regulated should make better returns than two entities that have to, at least pretend to, compete. Businesses getting bigger is the natural process. Big businesses have more money to invest into more growth and more opportunities. And if these companies can't create something from scratch, they will just buy it from someone who can. So far, you have seen how the shifting role of private equity in broad market asset managers has accelerated this.
I don't know if I agree with
but
that.
But there's another group that's emerged that stops a lot of companies from even existing in the first place. Ironically, venture capital is a niche of private equity that focuses on funding hopeful startups rather than large existing businesses. In theory, lots of venture capital activity should encourage lots of new business development. But the industry has realized that's not the best way to maximize returns. The best way to make money is to instead scale a business really quickly in the hopes that the big tech companies will just acquire it. A paper published by the Journal of Information, Economics and Policy found that this process systematically stifled genuine innovation because businesses were funded to be sold, not to actually provide value to the market. The problem is if...
Yeah, I mean, this is like the guy that, Nikita Beer, dude. He founded the same app 3 times and just sold it to different tech companies. He sold to Discord and to Facebook, and I forget what the third one is, but it's the same app. And all 3 times, it failed after they bought it. That's actually so fire.
If these companies try to start a service that competes with one of these companies' existing services, venture capitalists don't want to touch it because it becomes far too risky. The existing company with huge cash reserves can compete with the fledgling startup until they have run out of cash and then go back to business as usual. This creates what the economists affectionately branded kill zones, where startups find it really hard to find investors once they threaten the existing big businesses. The most laughably ironic thing about all of this is that yes, businesses with more market power are bad for consumers, who they have more price control over, and even worse for employees who may only have 1 or 2 companies where they can get a job with their skills.
I mean, this is just, I'm not trying to be reductive here. It's complex thought, and there's different solutions, but, one that has worked in American history and one that I think was trying to be worked on by Lena Khan is just non-rubber stamp antitrust enforcement. If you just challenge some of these buyouts and it suddenly becomes obvious that as a big corporation, you can't just outsource your innovation to the small companies you're going to buy out. I think people have this idea that big companies will always win, when historically, big companies are the slow-moving, lumbering, anti-innovation, backwards giants that lose. They often are bad. But the problem is the rules have been changed to where anyone threatening them, they can just buy out or kill using other methods. And that distorts the whole system. I think there's a good argument to make that historically, the bigger a company gets, the worse it gets. And the more easy it is to beat in the market. If you were allowed to compete fairly. It's not like there's a massive advantage. It's just that it's sort of the out of competition stuff, the meta game around the game of product versus product. That's a great example, though. I think a great example, someone said video game companies, and that's a great example where that's a market that is somewhat functioning. That is a market where competition still exists and it's working. And you'll see that, size is not helping these companies. Sony can throw $100 million at Concord or the studio that made Suicide Squad, or the money and the scale and the size gives them no advantage. The product is worse. They're getting beaten by single-person devs. Indies are crushing them. What was that game, Repo? Repo is a one-person developer. That game is crushing every AAA title this year. That's real competition. But in a lot of industries, we don't have that. We don't have a level playing field where the small business can compete. They just get snapped up. Oh, Schedule 1 was one person. Repo's a small team. You're right. Schedule 1 is one person. But both those games are crushing big AAAs. Repo's a small team, you're right.
But the great business extinction hasn't even been good for investors. As private equity, venture capital, and asset management firms have become larger players between investors and the companies they are investing in, they have soaked up more money in commissions, fees, consulting dues, and performance incentives. Income from the finance industry used to account for roughly 3.5% of GDP until the early 70s, but today it accounts for over 10% according to data from the Bureau of Economic Analysis. That's 10% of the country's entire economy dedicated to paying bankers and financiers to move assets around between one another. The assets held by these institutions has also grown from less than 50% of GDP in 1980 to over 180% today. This means that a lot of these firms aren't too big to fail. They are just too big. Regulation should be here to deal with these misaligned incentives, but the last time the FTC ever broke up a company was right here in 1984 with AT&T. Since then, the only punishment for anti-competitive use of market power has been fines, and well, you know the thing about fines. Now, if all you have learned from this is that finance bros are sponging up an ever-increasing share of our economic activity, go and watch this video to find out what these jobs actually do, because it's a lot different than you might expect.
You just
And
said
don't forget to like and subscribe to keep on learning how money works.
Fun video. Thanks for including me. Well, I don't know if it's fun in that it's a little dystopian, but it's interesting.